Hello Internet, my name is Ryan Ingram and today we're going to talk about two properties that I just purchased as a package for $65,000. To be even more specific, one was $25,000 and the other was $40,000. So they're both currently occupied. They came with tenants. I don't have many good pictures of these properties for that reason. However, I do have tons of numbers to talk to you about. So on this particular package, the total price was $65,000 and that is the exact amount that we borrowed. Now the financing on these two properties is actually pretty cool. So what we agreed to for this deal is we borrowed $65,000 at 9.5%, and the first year it is interest only. And then after the first year is complete, it's going to switch to a 7-year amortization, which is going to hike the monthly payment all the way up to $1,062. Now, after the first year, there is no prepayment penalty, and since we purchased both of these at a lower purchase price, there was in fact a great deal of equity in both of these properties. Now, the one for $25,000 does have some interior deferred maintenance, but it also probably has a lifetime tenant. So he has no intentions of moving out anytime soon. And I would estimate that the ARV of that place after we make those interior repairs is probably somewhere in the ballpark of about $55,000, which I'm guessing just because everything is fine structurally, it's just cosmetic. I think we could lay down new flooring and paint the walls for probably somewhere around $5 or $6 grand. So I'm very comfortable in thinking that there's about $25,000 worth of equity inside of this property. And as far as the one that we bought for $40,000, that is a much larger property that again is also in phenomenal condition. And I think retail, we could probably sell it to an owner occupant at about $65,000. So conservatively, we have about $50,000 worth of equity immediately from these two properties. Now these two properties came from a wholesaler, and generally in my experience, wholesalers come with like one or two good deals and then they kind of fizzle out. But this guy actually seems to have some really solid connections, so hopefully these continue to come. Now, as far as the income of these two properties, the one that was $25,000, that is rented out for $500 per month, and the larger one is rented out for $750 per month. Now, since these two properties were purchased as a package, for whatever reason, my brain just finds it most efficient to lump these properties together in one video and just go over the expenses together, because that is how my brother and I analyzed this package as they were being sold together. So on the insurance side, the insurance is in the mid 900s for the year, so it's about $80 per month. Now these two properties are actually inside of the highest taxed part of the county. I'm not so sure what the reason for that is, but nonetheless these taxes are pretty high. So they're about $2,000 per year, a little bit over that, and right at about $170 per month. And as I mentioned, we have interest-only payments for the first year, and I'm actually pretty proud of this. This is one of the lower interest rates we've received so far when we financed 100% of the purchase price and the repairs. Fortunately, all the mechanicals are new, AC on both, and new furnaces, new roof. It's a beautiful, beautiful package. So the interest rate on this is $514 per month. These properties were both kind of impacted by the tornado that we had last year, so the roofs are just a little over a year old. That tornado came around, I think, May 27th, so the roofs went on shortly after that. And even though my brother and I took property management in-house, we are still charging ourselves that fee. So even though it is, taking money out of our right pocket to put it in our left, I still like to include that just in case we decide to at some point outsource property management again or bring somebody in-house in order to do that for us. This is where their payment would come from. So the property management fee for these two properties is $100 per month. So all of these expenses together brings us to $864 per month. And since the income for both of these properties is $1,250, this deal is pretty solid. We are getting about $386 per month in cash flow, and since we walked into so much equity in both of these properties, then we are in a phenomenal position in order to refinance down the road. And really quick, this isn't something that I normally talk about or voice in all of these videos because these are just the deals explained. And in a few of the videos, I've kind of really gone over just with a broad stroke, my brother and I's business model. So I know a lot of the people that consider themselves to be uber conservative are immediately kind of off-put by the fact that we finance 100% of both the purchase price and also the rehab cost. Or like in the duplex where I purchased it for $25,000, we actually financed $10,000 more than the purchase price. But the only reason that we do this is sometimes we're afforded the opportunity to purchase properties greatly under their retail market value. Now, yes, this does come with a few strings. Sometimes there's deferred maintenance, problematic tenants, high maintenance tenants, or sometimes the rents are just crazy under market. So if that is the case, then there is a lot of work that we have to put forward to either fix the properties, raise the rents on the tenants, which is never a good or fun conversation to have, or otherwise just help the properties perform better. But nonetheless, since we are able to purchase properties as low as 30-40% of the market value, then that puts us at a really solid loan to value rate. On this particular package of properties with the purchase price of $65,000 and the after repair value or the ARV at $115,000, if you divide the purchase price by the ARV, then you're going to get the loan to value or the LTV at about 56.5%. So a lot of times when we are borrowing this money, we're doing so on interest only terms. Yes, this is going to be fully amortized, so that would immediately put our cash flow in the negatives, because that loan payment alone with the principal and the interest is going to be about $1,056. So if we add $300 to the $864, then that is going to take away just about all of the cash flow or bring us right up to break even. So it's not necessarily a bad thing since it's over 7 years. My brother and I are still flirting with the idea of just leaving it that way. That way we're paying it down pretty aggressively and constantly just month over month improving our loan to value percentage. But at the same time, there's also not really a need to do that. However, all that to say, when we are borrowing this money on interest-only terms, what we're really doing is taking advantage of the ability to find properties at a very low discounted rate, and then later on we're going to bundle these together and refinance them with a commercial lender that will allow us to put 20, 30, 40 single-family homes under one loan. And if you're familiar with commercial lending, then a lot of these banks are willing to lend between 70 and 80% loan to value. So if we were to refinance this one at 56.5% loan to value and we were to bump it up to, let's just say 70% loan to value, then we would be able to pull out about 13.5% of the ARV in cash. So we would be able to cash out and get lower terms because commercial lenders are generally lending about 4.5 to 6.5%. Now it is going to be an ARM or an adjustable rate mortgage, and it's probably going to be amortized over 20 to 25 years instead of the 30 that a lot of people are familiar with when they think about the single family homes. So all that to say, that is kind of how our business model works, which makes this a really awesome deal. Honestly, even if we keep the 7-year amortization period, that's still, in my opinion, a home run, because at that point, 7 years from now, we would own these two properties free and clear, which would get rid of this interest payment, which would, make this $900. So that, is a pretty solid cash flow, and that is, of course, assuming that capital expenditures, repairs, and maintenance will still come out of that. But nonetheless, over 7 years to kind of have a guaranteed $900 per month cash flow, or the ability to come over here and pull out 70 to 80% of $115,000 at any given time, that is a good position to be in. So that's just a little bit more detail than I normally give in these videos, because again, that's just broad philosophy that if you watch enough of the videos, you'll learn that that is in fact what we're doing. So thank you guys so much for watching. I really appreciate all the support. If you have any questions, comments, concerns, please don't hesitate to leave them in the comments, where I'm going to strive to answer each and every one of those. So thank you so much. Can't wait to talk to you guys soon. Thanks.